Real Estate, 40 and 50-year Mortgages by Albert Del Toral. Just because real estate prices have skyrocketed in the past 5 years and interest rates are on the rise, there is no need to give up the hope of buying that home you have been dreaming about. With new and creative financing springing up daily, there are a myriad of mortgage loan options that can still help you see that home buying dream come true. Two new options that are becoming increasingly popular as the year unfolds are the 40 and 50-year mortgage loan plans. Mortgage loans are adapting to the times. Just as car loans have had to increase their amortization periods from 3 to 5 years and then to 7 years in an effort to allow average income individuals to buy the expensive cars produced today, so have mortgage loans needed to adapt to allow this same population to buy homes, given the current real estate market conditions. 50 years ago, mortgages were amortized over 15 to 20 years. Due to interest rate fluctuations and inflation, which hit the price of a median home, mortgages extended to 25 and later 30-year amortization periods. Currently, not only is the market at its peak and interest rates gradually rising, but payment schedule changes are becoming due for many recent buyers who purchased with initial interest-only loans or adjustable rate mortgages, or ARMs, and now these people face heavier premium payments. Extending loans to 40 and 50 years allows these buyers to minimize their monthly mortgage payments. 40-year mortgage loans are not really something new. The 40-year fixed-rate mortgage was created in the late 1980s by several California savings and loan associations to facilitate home purchases in their incessant real estate market. Yet it was not until June of 2005, when Fannie Mae announced that they would start buying the 40-year loans, that this type of loan became popular. Fannie Mae is the nation's largest mortgage finance company. It is a government-sponsored enterprise started in 1968 to expand home ownership opportunities by joining with lenders and community partners to create new products and technologies. With Fannie Mae taking the initiative to buy 40-year loans, many credit unions and qualified lenders are also taking the plunge. Both Bank of America and Washington Mutual are now advertising these loans, and many other banks have announced that they will be joining them before the end of this year. In California, where these loans were first introduced, nearly a quarter of all mortgage loans are currently being written as 40-year loans. Unlike other innovative loaning plans, the way 40-year fixed interest loans work is quite simple and upfront. To finance your home, you go to any lending institution and complete paperwork identical to that of a 30-year loan. The difference is in the length of the payback and on the interest rate available. Interest rates on 40-year loans are generally around 0.25% higher than on 30-year loans. However, for those seeking these loans, this is a small price to pay for stretching loan periods, thus qualifying for larger mortgages with lower payments. Today, banks are offering an array of creative loans designed to provide customers with lower mortgage payments. These loans include the 40-year mortgage. Clients not only enjoy a lower payment, but also have the security of a long-term fixed mortgage. I look at the 40-year loan as a possible option when my clients ask me to get them the lowest payments possible. It is a very safe loan to offer them, added Manny Garcia, principal broker at Honor Mortgage. The 40-year loan is most popular with first-time homebuyers and people who need all the help that they can get to purchase a home. As Sandy Cutts, Fannie Mae spokesperson, highlights, it also could be helpful in general for borrowers who are challenged by affordability issues and for those who live in high-cost areas. Lenders also note that the 40-year loans are somewhat easier to qualify for than the 30-year mortgages, and borrowers can get approved easier for larger loans. High-income borrowers may also want to look at the 40-year loans, since the mortgage interest payments can be used as a tax deduction. To qualify for this type of mortgage, borrowers may not exceed 28% of their monthly income, nor 36% of their total debt payments, including the mortgage. My incentive was to clock in my purchase before prices kept rising and reduce my monthly cost as much as possible. I don't plan to live in my house for 40 years anyway. I just want to be able to make my payments until I sell it, stated Neil Frangier, a retired flight attendant living on a fixed income. The idea that many people will never reach their 40-year commitment is not overseen by lending institutions. Statistically, the average person in the United States lives in the same home for about 7 years, and most homes are resold within 10 years. For this reason, those who seek this type of loan do not worry about adding up the interest that they will pay over the life of the loan. In fact, some brokers believe that the 40-year loan is a good choice for homeowners who have a limited time frame in which they will own the home or keep the loan, since in today's high inflationary real estate market, rises in equity are higher than the short-term payments. Elderly buyers who are worried about leaving a long payment schedule to their children should also consider this principle. Critics of the 40-year loan, however, may highlight the excessive interest payments associated with the longer-term loans. Of course, it is true that spreading payments over a longer period of time substantially increases the total interest paid by borrowers over the life of the loan. For example, a $200,000 loan at a 7% interest rate would pay $279,000 in interest over 30 years, in contrast to $414,000 over 40 years. Computed using 7.25%, a slight increase usually tacked onto the 40-year rate. Extending the mortgage period also slows the rate at which equity builds, since payments in the beginning years are mostly interest and barely reduce your principal. On a $200,000 loan at 7% with a 30-year mortgage, $164 of the first $1,330 of the total payment goes to reducing the principal balance, versus $71 of the first $1,279 of the installments on the same loan using the 40-year financing method. Some would also argue that the extended payment schedule does not really save all that much money every month. However, this difference in payment schedule may be just that little extra help that someone needs to make their payments. If borrowers would like to lower their payments even more, they may prefer the super-sized mortgage loan of 50 years. As a leader in the mortgage loan market, California is beginning to offer this as a rational way to avoid interest-only mortgages to their clients who cannot make large monthly payments. The most common 50-year loan is a 5-to-1 hybrid, with introductory interest rates lasting 5 years and rates that adjust annually. As this becomes more popular, it will be interesting to see how these mortgages evolve. While these alternative loans can make the dream of homeownership a reality for some consumers, it is important to realize that they are not for everyone, and that there are downsides to both. Irregardless, it is safe to assume that mortgage companies, banks, and brokers will start to strongly market these loan products to their consumers. It is always beneficial to have options.